Ever wish you had a quick way to just get what's going on inside those dense company financial reports?
Oh, absolutely.
Yeah.
You know, those official filings, the auditor notes, investor decks, they've got the story, but sometimes it feels like wading through treacle.
Exactly. Like you need a decoder ring.
Hmm.
And that's kind of why we're here today.
Right.
We're going to do a deep dive into the latest results from CIE Automotive India Limited.
Yep. Specifically, their unaudited, standalone, and consolidated figures for the quarter and half year that ended June 30th, 2025.
Our mission really is to cut through the noise, pull out the key bits from all that source material.
And help you understand not just the numbers, but the story behind them, what's really driving the company.
So the big question we're tackling is, how did CIE Automotive India actually do in the first half of 2025?
And what do these results signal about their health, their direction, especially when you break it down by geography?
Okay, so let's start broad. The consolidated picture. Give us the overview.
All right. So looking at the consolidated top line, that's revenue from continuing operations for the half year. It landed at 46,416.32 million Indian rupees.
46,416 million. And how does that compare to last year, same period?
Well, H1 of 2024, the figure was 47,194.90 million. So you can see there's a slight dip.
Okay, a small decrease in overall revenue. Interesting. That tells us something already.
It does. Suggests maybe some pressure. Makes you want to look a bit closer.
Definitely. So revenue's down slightly. What about the bottom line, profit after tax?
Right, PAT. So after everything's paid, the net profit for this first half of 2025, it was 4,099.29 million INR.
And last year?
Last year, same period, it was 4,473.03 million.
Oh, okay. So that's more than a slight dip. That's about an 8% drop, right?
Exactly. An 8% fall in net profit. That's quite noticeable. Less money hitting the bottom line compared to the revenue change.
Yeah, 8% is definitely something to dig into. What about operational efficiency? Like the EBITDA to sales margin?
Good question. The consolidated EBITDA margin, that's earnings before interest, taxes, depreciation, amortization as a percentage of sales, it stood at 16.3% for this first half.
And previously?
It was 17.7% in H1 of 2024.
So that's down too. Tighter margins then.
Yep. It indicates they were generating a bit less profit from each rupee of sales at the consolidated level.
So, okay. The big picture is slightly lower revenue, noticeably lower profit, and tighter margins overall.
That's the consolidated story, yes.
Yeah.
But as you hinted, it's really a tale of two very different situations when you split it geographically.
Right, this is where it gets fascinating. India versus Europe. Let's start with India, sounds like the brighter spot.
Definitely the brighter spot. For the first half of 2025, India's segment revenue actually grew. It hit 29,818 million INR.
Okay, and how does that compare?
That's up 5% from the 28,588.17 million they recorded in H1 2024. So solid growth there.
A 5% increase. Nice. And profitability in India.
It's also solid. The profit before tax and interest, the segment result, came in at 4,117.1 million INR for H1 2025. And, contextually, their growth was pretty much in line with the Indian market itself.
So they're keeping pace with the market. Can you give us a feel for those market trends? What segments were moving?
Sure. So for H1 2025 in India, light vehicles, the under 6-ton category, production grew 4.0%.
Okay.
Medium and heavy commercial vehicles, MHCVs, were up a strong 9.6%.
Wow.
Tractors saw impressive growth at 12.3%, and two-wheelers were up 3.2%. So pretty consistent across the board.
Shows they're well-positioned in India. Now, I saw notes about some one-off benefits in India. Can you explain those? Why do they matter?
Yes, important point.
Yep.
So in Q1 2025, they had a positive one-off boost from something called the Zahirabad Mega Subsidy. It was about 87 million INR.
Okay.
That added about 0.6% to sales in terms of EBITDA impact for that quarter. But the key thing is it's not recurring. It's a one-time thing.
Right, so you need to mentally adjust for that when thinking about ongoing performance.
Exactly. And similarly, back in H1 2024, their EBITDA had included a 0.8% point benefit from a non-recurrent extra subsidy in their CK Seal unit, CIE Aluminum Castings India Limited. That was 220 million INR.
Got it. So strip those out to see the underlying trend. What about the future outlook for India? More growth expected?
Generally, yes. The forecasts look pretty positive. IHS, for example, sees passenger vehicle production growing 5% between CY24 and CY25, and then a 4.5% compound annual growth rate, CAGR, from 2025 to 2030.
That sounds healthy.
It is. MHCVs might dip a little in FY26, maybe 2-4% according to Crystal, but then they see a 2-4% CAGR through FY30.
Okay.
Tractors, similar story. maybe a 3-5% decline in FY26, but then a strong 5-7% CAGR forecast after that. And two-wheelers look set to rise 7-9% in FY26, with a similar KGR through 2030.
So overall, India looks like a solid bet for them.
It certainly seems to be their main growth engine right now, which brings us to the contrast, Europe.
Right. So if India's the engine, what's happening in Europe? It sounds like it's a different picture.
Well, yeah, significantly different, more challenging. Europe's segment revenue for H1 2025 was 16,164.09 million INR.
Okay, and the comparison.
That's down 11% from 18,063 million in H1 2024.
11%. That's a big drop, not just a slight dip.
No, it's a substantial contraction in their European business top line.
Ouch. How did that flow through to profitability in Europe, and what's causing such a slide?
Well, the profit before tax and interest in Europe really took a hit. It fell to 1,477.16 million INR in H1 2025. That's way down from 2,208.02 million a year earlier.
Wow, big difference.
Huge. The sources mentioned a few things driving this. There was a real sales drop in volume of about 4%. It was selling less stuff.
Okay, lower volumes.
Yeah. Now, interestingly, that was partly offset by exchange rates fluctuating in their favor, which added about 7% to the reported revenue in INR terms.
Currency effects cushioning the blow a bit.
A bit, yes. But then you also had raw material price reductions of around 4%, which can also lower the revenue figure, even if it might help margins sometimes.
And
crucially, there was a one-off restructuring cost in Metal Castello. That negatively impacted their Q2 2025 EBITDA margin by about 1.2% over sales.
Restructuring, so trying to fix things, but it costs money up front.
Exactly. Painful now, hopefully better later. But it definitely dragged down the H1 profitability.
So what's the outlook there? Is Europe expected to bounce back quickly, or are these headwinds likely to stick around?
The forecasts for Europe, excluding Russia, are pretty muted compared to India. IHS predicts light vehicle production will actually decline by 2.9% between CY24 and CY25.
Decline, okay.
Yeah. And the longer-term CAGR for light vehicles, 2025 to 2030, is only forecast at 1.1%. So quite sluggish.
Not great for a core market. Yeah. What about heavier vehicles?
The HCVs look a little better. IHS sees 3.0% growth between CY24 CY25 and a 2.7% CAGR for 2025-2030. So some growth, but nothing like India.
Right, a much tougher environment. And there was a small note about reclassifying a Mexican subsidiary, Bill Forge de Mexico.
Ah, yes. That's more of an internal reporting change. Bill Forge de Mexico used to be reported under CIE India. From Jan 1st, 2025, it's being evaluated as part of Europe, specifically under their Galfor subsidiary.
But it doesn't change the overall consolidated numbers.
Correct. No impact on the total company results. It's just about how they group things internally for analysis.
Okay. So let's connect the dots here. We've got strong India, struggling Europe.
Precisely. And that European decline, including those restructuring costs, is basically canceling out India's good performance when you look at the total consolidated figures.
It's like one step forward in India, almost one step back in Europe.
That's a good way to put it. It really highlights the challenge for management. India's the growth story, Europe's the drag. Their focus seems heavily on fueling that Indian growth to hopefully overcome the European weakness, especially since the outlook there is, well, uncertain.
Okay, that regional picture is clear. Let's look under the hood, a bit more balance sheet, cash flow.
Yeah.
How's their debt situation?
This is actually a real positive in the report. Their net financial debt, NFD, has improved quite a bit.
Oh, really? How so?
At the end of December 2024, it was around 12,022 million INR. By June 30th, 2025, it had dropped significantly to 7,639 million INR.
Wow, that's a big reduction, almost halved it. What drove that?
Primarily good cash generation from operations, which we'll get to, plus disciplined spending. They're clearly focused on strengthening the balance sheet.
And the ratios reflect that. NFD to EBITDA, NFD to equity.
They do. NFD improved from NFD to EBITDA down to negative 0.11, both showing much less leverage. A healthier debt position gives them more breathing room.
That's definitely good news. You mentioned operating cash flow was strong.
Yes, the report notes good operating cash flow in both regions. The consolidated figure for each one 2025 was 5,534 million INR.
And how does that relate to their earnings?
That cash flow represents 76% of their EBITDA for the period, which is pretty strong. It shows they're good at converting those earnings into actual cash. That's crucial for paying down debt, investing, paying dividends.
Speaking of investing, what about CapEx? Are they putting money back into the business, especially India?
Yes, CapEx is described as growing, and it's mainly focused on India, which fits the strategy we discussed.
Makes sense.
But they also highlight strong CapEx control, keeping it under 5% of sales. For this first half, The growing capex figure was 704 million INR. So investing, but carefully.
Okay. And dividends, anything notable there?
Yes, they paid out a significant dividend in Q2 2025. It amounted to 2,656 million INR,
Wow.
which works out to 7.000 INR per share for the financial year that ended Digital-Indy 31/2024. So solid return to shareholders.
Right. And finally, on the financial health check, what about returns? ROE, RONA.
Return on net assets, RONA, was 16.8%. Return on equity, ROE, was 11.8% as of June 30, 2025.
And how does that compare?
They're down a bit from the end of 2024 when RONA was 19.8% and ROE was 12.6%.
So a slight dip in returns, reflecting maybe the tougher overall environment.
Likely, yes. But still, those are respectable return levels. It shows the company is still generating decent profits from its assets and shareholder investments, despite the headwinds.
Okay, so financially, despite the profit dip, they seem to be managing things quite tightly, reducing debt, generating cash, controlled capex.
That seems fair, yes.
Now, there were also a couple of other sort of strategic points. The discontinued operations, what was that about?
Ah, yes. That relates to a significant move they made in Germany. CIE Forgings Germany, CFG, sold off its 100% stake in 4 German subsidiary companies:
Which ones?
Chico Gellinghaus, Gesangsschmiede Schneider, Fulkenraff Formtechnik, and Schoneweiss & Co. They were all sold to a company called Mutaris.
So slimming down the German operations.
Exactly, a strategic divestiture. The small amount reported under discontinued ops for H1 2025, about 13 million INR, was mainly just some trailing interest income. It simplifies their European setup.
Got it. And the other point was about government grant income.
Right. This relates specifically to their CKCL subsidiary in India, the aluminium castings one.
Oh.
They're eligible for incentives under a Maharashtra government scheme, PSI 2013. It basically gives them refunds on certain taxes paid, like VAT or SGST.
And that's ongoing.
Yes, the scheme was extended up to Jan 31st, 2025, and it has a potential maximum value up to about 3,112 million INR. So it's a nice continued benefit that helps their cash flow and bottom line in India.
Okay, so we've really covered a lot of ground here on CIE Automotive India's first half results.
We have. And the main story, to recap, is really that strong showing in India, acting as a counterbalance to the quite noticeable challenges and weaker performance in Europe.
Along with that, we saw definite improvements in debt management and these strategic moves like selling off the German unit.
Right. Streamlining and focusing.
So for you listening, this really leaves us with a key thought, doesn't it?
I think so.
Given this clear split performance, strong India, weak Europe, how does CIE Automotive India navigate this going forward?
Yeah, how do they manage that uncertain European market while making sure they keep that Indian growth engine firing on all cylinders?
What strategies might be critical for them to really optimize things globally in what's obviously a very dynamic auto components sector?
And what could that mean for their whole business model over the next few years? Definitely something to keep an eye on.